everyone, hope you're doing well. This is the Deep Dive. My name's Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And today I'm joined by John Creekmer, our Senior Wealth Advisor and Founder. And John, we're going to talk about a grab bag of questions that we've had from folks that we've just been talking to over the last few months. We're going to kind of walk through some of them because we think some are timely and others are really key cornerstone retirement planning questions that we really want to provide some clarity to everyone on. So we'll dive into those questions here in a minute. But before we do that, John, how you doing today?
So, Drew, you kind of saying like Blue's Clues, like mailbag? Kind of like, mailbag.
Say we need to get that theme song put in here.
Wouldn't it be great? Maybe it's a regular segment, and I don't know. Maybe we could start wearing like little blue sweaters during mailbag, and that could be our theme.
Or we could wear the green long sleeve shirt that the fella on Blue's Clues wears. That thing is a iconic look there.
Yeah, I think did he come back recently as far as with like a PSA about being nice to everybody or something?
Yeah, he did, but it was a little shocking because I remember right, I think he was completely bald, which was completely different from what he looked like 15, 20 years ago.
Scared all the children and everyone, all the adults recognize, I'm getting old. Yeah, maybe not. We'll see how it goes on there. See how crazy you want to
be. Yeah, absolutely. So let's kind of dive into it. You know, I was having a conversation last week with me with clients up in Bourbonnais, and one of the topics that we really spent a lot of time talking with this particular couple was about Social Security. And they've been doing some research. They're getting close to retiring. And John, as you know, there are thousands of different ways that you can claim Social Security. So there's a lot of confusion. But it's a topic that's a really key part of your retirement income plan, and it's something that you've been paying tax dollars into your whole working career. So making the right decision with Social Security is key. So big picture, what are some things for people to keep in mind with Social Security?
I think it is still key. So we know that really, as far as in retirement, if there's no income, there's no retirement. And so it's as simple as that. And back in the day, Drew, when I first started working in financial planning, we looked toward that cornerstone, and they used to say there's this three-legged stool of retirement income. And so one was Social Security, one was withdrawals off of your investment accounts, and the second one was corporate pensions, or government pensions, if you will, depending upon who your employer was. And a lot of times we've seen over the years that the pension has kind of gone away, and so a lot of people don't have the pension. Right. So when it comes down to the guaranteed income streams, they really only have Social Security. And so that's their primary guaranteed income stream. Now, there's things we can do inside your portfolios to structure the income out for yourself, so it's more of a guaranteed income source. But when it comes to third party, it's really that Social Security. And Drew, there's over 1,000 different ways that a legal couple, is able to file as far as to be able to start their Social Security income stream. Now, there used to be more than that, and then the federal government changed the rules on Social Security about 6 years ago, to where now I'm down to about 1,000 different filing scenarios. And we have found that the average person makes a mistake in the filing, and they're actually leaving, when it's all said and done, over $100,000 of misplaced or less income in their Social Security over their lifetime because of that one mistake. And so it is critical to get it right and not make the mistake. There's a number of components that go into that calculation.
Yeah, absolutely. So we would definitely say if you're approaching Social Security age, absolutely talk to your advisor. We have software that helps with your particular situation to make sure that you're claiming at the optimal times. And John, one of the things I wanted to mention is something called a spousal benefit. And it's because the couple I was chatting with, one of the spouses had worked full-time while the other one had not worked for a number of years, but did have enough credits to take Social Security. And so when we started working through what a spousal benefit was, it really became clear that could add a ton of potential income to their plan. And I realized in talking to them, they never heard of a spousal benefit before. So can you kind of walk through what that is? Because I think that situation applies to a lot of folks that we work with.
Yeah, it does. And so really the spousal benefit would apply in a situation like you just described. And so typically whenever you're working, and if you work and earn a minimum dollar amount over a calendar quarter, well, that means you qualify to have 1 quarter of earnings. And you need to have 40 quarters of earnings to be eligible for Social Security income as far as in the standard without any exceptions. Now, your earning that you receive from Social Security benefit is really based upon the dollar amount that you made in that quarter. And so the higher the level of income that you had in that quarter, then you would have more money coming to you whenever you retire and you claim your Social Security benefit. And so there's a lot of people, though, that because of life choices, but also because of just circumstances. So we have found that, let's say that we have a married couple with a husband and a wife, that one of those people has typical responsibilities, both for caring for aging parents, but then also for spending more time away from work in the raising of children, or taking time off of work as far as to get children moving from one location to the other. And historically, and I know we have a changing society, but historically that has fallen upon the female in the relationship. And so we're taking time off to care for aging parents is the other thing that we're seeing even after kids get out of the house. And so in that case, typically the female has a lower Social Security benefit than the male in most cases. That does not always hold true. What this spousal benefit says is that as long as you have at least 40 credits, well, then you have the ability to claim on the higher of your benefit amount or your spouse's benefit amount, whichever is higher. Now, it's not a straight getting 100% of your spouse's.
Right.
There's an actual calculation that goes into that. But typically, you can claim on either your benefit or 50% of your spouse's benefit and receive the higher dollar amount, and then allow yours, and let's say you're in that situation where 50% of your spouse is higher, you allow yours to continue to grow over time.
Awesome. So we would highly encourage you, if you have heard a few things we talked about here and you're like, oh, that's interesting, or that's something new, or I'm just getting close to Social Security age, absolutely reach out to your advisor and chat with them the next time you're together. And John, one of the other key planning tools that I know I've talked with clients about recently, and you have as well, has to do with charitable giving. And there's two main ways that's come up. One has come up with RMDs, and the other has come up with something called a donor advised fund. And so let's kind of break this down. Let's walk through the RMD situation first. How can someone who is receiving at the age of 72, they have to start taking a required minimum distribution from their IRA account, how can someone actually use that to achieve their charitable goals or desires?
So once you hit the age where the IRS says that you're old, and keep in mind that I did not say you were old, but the IRS says you're old. So if you didn't hate them already, I'm sure you can hate them now, which currently is age 73. You're required to do what's called a required minimum distribution out of your pre-taxed accounts, which would be your IRA, your traditional IRA, or 401k, or 403b plan, whatever your flavor of your retirement plan is. And with that, it's based upon your life expectancy. So it's about 3.6% of your initial balance whenever you turn age 73. Every year that percentage goes up. If you're charitably minded, you have the ability to have that RMD go straight to an official 501c3 or not-for-profit organization. And for most of you, that would be your churches. That would be like someplace like St. Jude. It could be a hospital. It could be other charities, but they have to be an official 501c3. The dollar amount of the check can go straight to them for either 100% of your RMD amount or a portion of it. And so we have some folks, let's say their RMD as an example is $10,000. They may say, hey, send $5,000 to my church and send $5,000 to me and withhold for taxes on the $5,000. So flexibility on that. The big thing about that is that you do not receive, it's not a taxable event. And so therefore you're not paying tax on that. It does not show up as taxable income. But also that means it does not count in as far as for your taxation on your Medicare payment. And so there's no Medicare premium penalty for some people. So it's something where if you are charitably minded over age 73, you're probably not itemizing as far as on your deduction. It's a way of actually saving tax dollars. So it's something you want to definitely pay attention to.
Absolutely. Now, the other side of this conversation is the donor advised fund. And this is a tool that we've seen become much more popular in the last few years. And we've had clients utilize a donor advised fund to help, one, give in a charitable way, but two, also manage their large tax events, such as selling a business or a large amount of stock options vesting and being paid out. And so, John, what is a donor advised fund, and how have we been implementing that with folks?
Yeah, so a donor advised fund it truly is a 501c3, and its main purpose is to help people give money to other 501c3s. So what you do is you set up a donor advised fund account, and whenever you think about that name, it's a fund that is advised by the donor. So in this case, the client is the donor. You can put cash in there, but typically most people put highly appreciated stock. And so if you have a non-qualified account and you have a stock or a mutual fund or an ETF, and you have a high appreciation there, or let's say you have real estate even, you can actually donate to the donor advised fund. The donor advised fund, then you could choose to leave that investment in there if you like, or you can sell it. When you do that, there's no capital gains. And then whenever you do that, then you have the ability to let the money sit there and grow. But then you simply every year, at any time during the year, you create what's called a grant to be sent out to whatever charities you want the funds to go to. So it's a way of getting money in a deductible way to go to charity, but to do it in a way that makes sense of highly appreciated assets such as individual stocks. Drew, some strategy we've seen is incorporating using a donor advised fund and maybe putting 3 or 4 years of a contribution giving into the donor advised fund in 1 year, having a heightened itemized deduction to be able to offset additional income. So let's say you received some RSUs from your employer, or you have a large bonus in 1 year, and you want to be able to offset that decreased taxation to move down to a lower tax bracket. We have the ability to actually forward maybe 3 or 4 years of contributions to charity all in 1 year by using the donor advised fund, but then send the money to your charity, to your church, if you will, then pro rata over the course of 3 or 4 years. So it gives you a lot of high-end planning you have the ability to do.
Yeah, awesome. So what we would say is if you're approaching RMD age, or if you know there's a large liquidity event or a large amount of increase to your income coming up here in the near future, absolutely reach out. This is something that our advisors can help you with in conjunction with our operations team. And both options are fantastic ways to achieve some of those charitable goals you have, but also continue working towards your larger scale financial goals as well. So John, before we wrap up here, I want to put a bug in everyone's ear about 2 things. One is the TD Ameritrade to Charles Schwab transition, and the other one is one of our favorite events that we do. In the past, we've done every year, but during the COVID years, we were not doing this event. I want to put a reminder out there ahead of time on that. So, John, can you kind of walk through the TD Ameritrade to Charles Schwab transition? I know letters have gone out to folks, and so there's been more questions coming up. So what do we need to know about that?
Yep, a little over 2 years, Charles Schwab purchased TD Ameritrade. So you're bringing together 2 of the largest trading firms and custodial firms in the entire world into one organization. So a lot of great benefits. You actually have the best technology firm, which is TD Ameritrade, going together with the #1 rated client service experience firm, Charles Schwab. So a lot of positive synergies. Then you throw on top of that all the incredible service from a boutique firm like Creamer Wealth Advisors. We really think it's going to, in time, going to be a win-win-win. However, it's a large change. So just so you know, there's nothing that you need to do. On Labor Day weekend, you're going to go to bed and business is going to close on Friday night before Labor Day, and your TD Ameritrade accounts will be TD Ameritrade. But on Tuesday morning after the Monday of Labor Day, all of a sudden your accounts will now be Charles Schwab accounts. And so everything transitions automatically, nothing for you to sign there. And so everything should be seamless from the client's end.
Yep, awesome. And our operations team is sending out emails pretty much at this point every month with updates about where to log in to Charles Schwab, about an update on the timing of the transfer of accounts. So you will continue to receive communication from our team on that. And then, John, why don't you just wrap up with kind of a brief overview of the client event that we have coming up here later in the fall?
Yeah, so here in the Central Illinois area, we're having an event that we actually had for a number of years in a row before COVID. And we took some time off during COVID to make sure that we had a environment everybody felt comfortable. And so coming up here in the month of October, I believe it is, we'll start sending out invitations for this event in the fall. And we have what we call a stand-up magician is going to be there. He was one of the top 10 performers on AGT 2 years ago. And does a funny job, and it's kind of amazing with the work that he does. But really, it's a time to just have appreciation and say thank you very much. If you're outside of the area and want to travel in, that'd be great if you can make it. And if not, then we're planning on doing other events at different locations all around the country coming up here later on this year also.
Yep, and so we're really looking forward to that. One of our favorite events of the year, to get to see a lot of our clients in one place and catch up and just have a nice evening together. So Guys, thanks for your time. Looking forward to seeing each and every one of you here soon. If we talked about something today that you found interesting or you have questions about, by all means, reach out to us. We would love to chat with you. Thanks, guys. Have a good week.